I'm Janelle McGill, Realtor and Consultant in Northern Colorado, and welcome to today's Did You Know video. We're going to talk about metro taxing districts. So what is a Metropolitan Taxing District? It was created by state statute here in Colorado in 1978. And for the first couple of decades, it wasn't used very extensively throughout the state, but in the last 20 years or so, it has been used for a lot of new housing developments. What these are is a way for the developers to finance those new developments. And they do this by taking the infrastructure costs, the roads, the bridges, lights, curbing, sidewalks, utilities being brought in, and they roll that into a special tax assessment. What that does is it ends up making the house prices lower because all of that isn't built into the purchase price, but it makes the carrying costs higher. So often, because of those added tax burdens, your tax bill may be double what the base county rate could be. And there are obviously some issues associated with these tax districts. One of them is that there's supposed to be an end date. So conceivably, when it was all financed at the beginning, there was a certain amount of debt, and at some point it should be paid off through everybody's tax assessment. But because there's a lack of transparency with these districts, that date can be difficult to find, if not impossible. The other issue is that your home payments, which are now higher, are not building you equity. So you can end up having the same payment in a house with a tax district as you would buying a more expensive house in a different neighborhood, but the house that's higher priced actually builds more equity because more of your payment is going towards your principal instead of going towards your tax bill. And the higher property taxes can actually make it more difficult to sell in the future. So what was really attractive at the beginning, being new construction, is now gone once you've lived in it. So once you sell that house, it's now a resale property just like other competing properties, and it might be harder to sell because of that added tax burden. And probably the biggest issue, and something that's causing a lot of conversations right now in the Colorado State Legislature, is the amount of corruption, board member conflicts of interest, because a lot of the board members are the developers themselves, so they're the ones controlling this debt and also profiting off of it. There's a lack of transparency in when an end date is and how much the interest rate is, when it's going to be paid back, and there's very little oversight. So that's something that they're working on right now, but it's definitely not in place. What to look for. So if you're a buyer out there looking for a house and this is all new information to you, here's what you want to look for. The listing should mention whether it's a special taxing district or a metro tax district, something along those lines. If it does not say any of those things, what you should probably do is take that all listings should have the prior year's tax data available. Take that number and compare it against a home in a different neighborhood. See how the numbers compare. This information will also come to light while you're under contract during a transaction. So if you end up buying a house and you don't realize at the beginning that it's in a metro tax district, that will come to light before you go to closing, and you do have a right to object to purchasing that house when you find that information out. Other things to think about is that I believe in the future it's going to be pretty difficult to avoid buying a house that's in a metro taxing district because most new developments are doing this. So it's going to probably be a reality for everyone in the future. I would definitely right now, though, be especially wary of brand new construction. And the issue with that is because when you're one of the first ones to buy in a neighborhood, and it is a metro tax district, there is no historical tax data for you to find out what that assessment is. So they can give you estimates, but you're really not going to know until about a year, 18 months after moving in when you get that first assessment, and it could be quite a surprise. The last thing is ask your realtor. So talk to them. Make sure they know which neighborhoods are in a metro taxing district. If you're opposed to buying in those neighborhoods, then you can not look there. You can understand why those purchase prices are often lower than elsewhere in the community. And ask them to, if you do fall in love with a house that's in a metro tax district, just have them help you figure out what the total cost of ownership will be if you buy that, and make sure you know the ins and outs of these. So that's it. That is our Did You Know video on metro taxing districts.